Every major conflict in the last 80 years, whether it was a world war, the GFC, or COVID, people said, I'll wait until things calm down every single time. And every single time, the people who waited paid more for properties. Right now, the market's spooked. Auction clearance rates are down, Sydney and Melbourne forecasts have been revised, and if you're sitting on cash wondering whether to pull the trigger or sit tight, that's a completely rational response to what you're seeing. But the news is telling you one story, and 80 years of data is telling you another. Today, I'm going to show you exactly what the data says about how Australian property actually behaves when the world gets messy and why uncertainty is where the opportunity lives. All right, so agenda for today, we're going to go through just generally what's happening now. We've got some cool things, which I'll introduce a little bit later, but one of our PhD students who works for us has got some cool data. Out of curiosity, actually, no, we'll leave that. We'll get to that a little bit later. So we're going to do that. More importantly, we've gone through the last 30, 40 years of how geopolitics actually affects markets and even the time frame. So we've broken it down for like 1 month after, 3 months after, 6 months after, 12 months after. So you can just look historically exactly what's happened to the property market post major events. And we're going to go through all the different events. The 80 years of data is everything that we've go through with inflation, interest rates, world wars, minor wars, market sentiment, all that. And we're just going to look at how that outcome changes as well. Currently, what we're looking at, so we're going to do some actual data. So if you hang around towards the end, we're actually going to go through like the capital cities and major regionals, how they're performing at the moment versus a few months ago versus what we predict in the next few months. What this means for you, so i.e., within your portfolio, what should we be doing? Should we be holding property? Should we be selling? Should we be waiting? Should we be buying more? Every buyer's agent is always going to tell you to buy more. Like for whatever reason, the last 15 years, every single buyer's agent says, keep buying, but that's how they make money. So take what I say and what others say with a grain of salt and just make your own decisions there. And then the fun part, the Q&A. I actually find I get the most out of Q&A because it's what I do all day, every day, and it's not kind of rabbited information. You can ask me. So feel free to ask me about your portfolio, what you should do in your portfolio, general questions about the presentation, even unrelated to property. You've bought a shopping center and there's issue there because people get benefit from this. All right. So what's happening now? The unprofessional one is some dickhead world leaders are bombing civilians for no reason, and they just want to get control of some type of resource. But the professional answer is basically there's a US, Israel, Iran conflict. There's missiles blowing up people and they're trying to get control. But that's not the main thing. So that's what causes a flow-on effect. So we think it's the actual wars that we're going, but it's actually the financial markets that are moving based on something else. So it's normally like a flow-on effect, which will go on what those flow-on effects are. But then how that relates to property, the first signal that we've actually seen is auction clearance rates have dropped to the lowest they have in 15 months. So that's quite a big one. Again, take it with a little bit of grain of salt. Like the market has been incredibly hot, so the market had to cool at some point. We can't have increases on increases on increases, otherwise it becomes exponential. So those ebbs and flows are normal outside those circumstances, but this might just be the kicker for it. How geopolitics hits property. So I want to point out that most of this data came from Albert in our team, who just finished his PhD. So he just got his doctorate in, I'm going to read this for you guys, in commercial property investment decision-making amid economics uncertainties, the dynamic role of investor behavior. So he literally did his PhD in this topic. That's also how I came across him. So basically when he was doing his PhD a few years ago, he had to interview obviously like commercial agents, commercial commentators, and then it was basically me and Rethink that he had to reach out to get kind of buy sentiment side. And I helped him out quite a lot there. Kept helping him throughout his PhD and found him fantastic and was like, I want you to come work for me and do this full time, just do data. And he now works in our due diligence team and research team. So if you do use Palise property, he is making decisions based on data and he literally studied his PhD. He's the only person ever to study this on PhD. Check out as well, we've got a cool blog and video we did on how economic uncertainty affects retail centers. So if you're interested in commercial retail centers, that's probably a bit of interest to you. So write me an email and I can send that to you. But let's go through the chain. So he calls it the transmission chain. So we're at the geopolitical conflict now, as we have been in the past. The flow-on effect for that is obviously energy prices go up. So we've seen that through fuel, prices of electricity, all energy prices going up. Fuel's now, what, $3 a litre, whatever it is. Glad I've got an electric car on the side, but fuel's going up, which then leads to inflation, which then leads to interest rates, and then borrowing capacity actually falls because the higher the interest rates, the lower the borrowing capacity is going to be. And that's probably what we need to focus on today. I want to point out though, interest rates is not a sole indicator of what the property market does. I've seen other commentators and educators in this space saying, well, interest rates go up, property prices go down. We didn't see that. We saw that in like 2022 to 2025. Interest rates were going up and commercial and residential had some of its best growth ever. So that's just one indicator. There's other flow-on effects like sentiments and things like that. But the point down the bottom of the slide, you actually want you to read that carefully. Property goes a lot slower than other markets like shares. So you're actually going to see from the data that we present a bit later, it flows on 3, 6, 12 months later. So anyone trying to pick that period is completely different if you're buying shares. And also, because I'm also known as a commercial guy, different commercials act at different times to residential as well. Certain commercial are way more volatile, hence like office space. Something like hospital and healthcare is completely different. And then residential, the economy's part of that of do people actually pay their rent? But again, it still always comes down to supply and demand. And if you hang around towards the end where we actually go to breakdown of like what's actually happened the last few months across all the capital cities and majors, you'll see supply and demand still a big part of it. All right, so let's go through the fun / sometimes boring part for some people. Jeff Stevenson has just asked a question. I'm going to try to do this answer live. So I don't know what happens when I click answer live. Do you guys see the question or anything like that? But I'm just going to read it out anyway. What was the name of the person you mentioned who has the PhD on this topic? I'm going to get a butcher his name. It's Albert Abedeku Akeku. Go on our website about our team. You can read about Albert. So he's from Ghana, hence why I can't pronounce his last name. Probably should. Terrible boss. Now I think I write done for that and it disappears off the screen. Would you guys be interested though? I asked him this morning, he's got his PhD is hundreds of pages. If we summarize that for key topics in relations to property investors and making decisions into like a smaller PDF, would you guys be interested in that? If yes, write yes in the comments or email me after this and we'll put something together and send that out. Because just FYI, if you think my books are dry on investing, this is even dry because it's based on real large stats or it's got all the references. But if you're that type of personality, you'll love it. All right, so the typical year following pattern that we've seen every single geopolitical tension is the first shock and reassess scenario. This is where all the news headlines comes out and you've seen, and we researched, we had about 20 different headlines that were kind of highlighting this fact. I'm not going to post them here, but basically that's where everyone panics, everyone talks about it, it becomes a thing at the barbecues. That's the short-term period we're in now where every conversation I'm having about it. But I've got some thoughts on that, so I might save that kind of to the end. But normally, what happens is I always ask an investor, "Are you holding a property for the long term?" And then they say yes, and I go, "Well, why are we talking in 3-month periods? Like, I get it if we're talking to maybe the recovery phase, the 6 to 12 months, but why are we making like a 20-year decision based on a 3-month period?" But there's some scenarios for that we'll go through. After that, we've got the stabilization period. So that's generally just where we kind of work out where the tensions are going. Are they increasing? Are they stabilizing? It's going to sound really crude. Is it something we kind of forget about? There's lots of wars that are going on and we kind of just go, forget about it. And as long as there's not a flow-on effect from either energy, interest, inflation, or supply, we kind of get on our lives, which is a bit sad, but this is the way it is. And then the final one is recovery. So after the initial shock, we kind of see what's going on, but you're going to see through the data that pretty much after every single one after 12 months, not much has happened. However, markets within markets, which we'll break down a little bit as well. So here's one of the graphs he came up with. So I might have to explain this a little bit because when I first looked at it, it took me a little while to get around it. So basically the 1, 2, and 3 is the 3 months after a major event. 2 is the 6 months after a major event, and then 3 is the 12 months after. And then the blue one, the blue column chart, the 1.3, 2.6, 5.5 is the average S&P return that you'd actually get if you put invested funds. So if you put in funds into S&P 500, after 3 months, you'd get around a 1.3% return. After 6 months, you'd get a 2.6% return. After 12 months, you get a 5.5%. So obviously that starts compounding the longer you go. But generally, if you just started investing, that's what you'd get. This is basically the after effects of how we see property. You'll get 0.3%, then it'll go 2.6, and then 5.5. So pretty much on average, after 6 months, the market has stabilized. The question that most of you guys are probably going to know is, what are the opportunities in that first 1 to 6 months? We'll go into that a little bit, but you can see here, and I'm going to prove it with the next one. Here's Sydney house prices, and I'm going to have to go to the next graph as well, through every conflict. So we go through World War I, World War II, the Korean War, Vietnam War, Cold War, oil crisis, Gulf War, GFC, COVID, Russia-Ukraine war, now in the Iran conflict. And we've plotted that on the graph of Sydney house prices. We've also got a graph on the right with all the other capital cities, but let's go to the Sydney one now. You can basically see up till 20, so we start from 1980 to 2024. Basically, up until we get to the 2000s, prices are pretty fine. Then they start shooting up. We get from 2016 onwards up to 2025, and that's where the market starts going nuts. So you can see that there's no decline. Like every single event, no major decline. It's stable. I'm not saying they don't soften, and this is why I put the graph on the right. So the 3-year growth after major events, they're all still in the positive. So the main one we actually saw was the GFC. So yeah, probably your argument's going to be it's not the wars, it's going to be like a major financial crisis. Then the question becomes, well, where's the most stable part of the money? Having a positive return, you can still see that it's still 3-5%. Is that probably better than putting money in shares, putting money in the bank, leaving it under your bed, buying gold or silver? I'm not an economist. I'm the property guy. I'm always going to put my money into land because they're not making any more land, and we're having wars over land for thousands of years. So for me, it's always the most common thing I can have where it's going to be in line with the market. And I've been asked before, people say, oh, what happens if your portfolio, Steve, drops by 50%? I can still, and this is because I'm a low risk investor, have a low LVR, I'm still going to have a better life than the person next to me, because assuming all my properties are rented, that rent means, let's say I got 10 properties. I'm going to have 10 times more rent than the person next to me. So unless they've got some other asset class that's outperforming property, I can still manage that. But you got obviously risk profile. This is where, like, I think people that go up to 80, 90% LVRs in their later years is really risky. So maybe we'll have some questions around that around the end of, like, when should you maybe change to a lower risk strategy versus what outcome you're getting. But the graph on the right, the 3-year growth after major events, like it's probably, if not the time to buy, because you can see pretty much every single major one, we've had 30% plus across all the capitals. So the only one that didn't have it was the GFC, which we had the stagnant period. So we can sugarcoat this how you want, and you can say this time is different. I was talking to a client yesterday, and when I spoke about this graph, I actually pulled it up on a call, and they said, well, that line's getting exponential, Steve. That can't last forever. Potentially, but who's to say? Like, I've been doing this for 10 years now, and every single time they're saying, oh, it's going to stop. It's going to stop. But property could potentially just become a commodity where it's no longer a right where people would have to buy it. It's just like a share that can keep growing, and it might get more volatile. But like I said, people need a roof over their heads. People need warehouses to supply these roofs. Like, we've still got that need for that. I actually chucked this graph in myself just because I think it's a really cool kind of graph. And I've just never seen property presented for growth this long. You kind of get the capital, so you can see like the line charts. But I actually like how they've bulked it through like major like growth periods. So you can see from the 80s where the market moves in the last 40 years. There's some cities, you can see like Canberra had like a period of 0%. Then Melbourne's 1.2% from 1990 as well. But on the whole, they're still all in the positive. The art of investing is not like, It's not the structure of buying property. That's simple. It's trying to, if at the start, buy in the right areas to get that capital growth to maximize the leverage to get into the next one. That's the game of property. Long term, from the last graph I showed you, it doesn't matter what you bought. You could have bought anything 30 years ago and you're fine now. But if you're in the accumulation stage, you really want that growth in the next 5 years to then buy another one, to buy another one. It just shaves 5-10 years off your investing journey, which means you can hopefully retire from work, spend more time with kids, be a bit more financially wealthy. But that's a really cool graph. I'll send this out. You're all registered, so I'll send the presentation out so you've got a copy of that as well. Here's another one I shared online about maybe 6 months ago now. I mainly do this to annoy the residential buyers agents because they always say, don't buy commercial, it doesn't grow. This was from, I think it was CoreLogic and Savills from memory, their data, and just did the last 20 years, capital city residentials versus commercial. And you can actually see, ignore Sydney industrial, it's just in a different growth cycle. But fun fact, they all grow in the last 20 years, 170-ish%. Every single one. So like I mentioned on the last slide, you're going to perform well long-term no matter where you buy, but choosing the right next cycle as compared to inflation, which is 67%, I'd say property's a pretty good gamble. Like it's a fairly safe investment. But again, all those people saying, don't buy commercial, it doesn't grow. Literally Perth commercial, Adelaide industrial, Sydney commercial, all performed exactly the same. It actually has to, because if it doesn't, there would be a big price disparity. So people will say, oh, if commercial's really expensive, how did it get expensive if it wasn't growing more than residential? But they just happen out of cycle. So what happens is if residential grows really fast, then people will move to commercial for a better yield, and then that'll grow and compress. So they just slightly happen out of sync. But on average, they have to be on par. If someone can afford rent, the businesses that are employing the people need to be able to afford the rent of the tenancy. So they have to remain somewhat comparable. All right, current market signals. Just checking questions first. Will today's webinar address the government's proposed tax policy changes? From Rodney. We'll get to that then, maybe with questions. Commercial interest rate at 7.4 and 2 more rate rises coming. Yields are less than 6%. Good question, Win. Sorry, I'm going to save those for the Q&A because I can rub it on about those for ages. So here's the city by city forecast. So SQM generally every quarter or major event will kind of just make some assumptions based on cash rate rises, inflation. This is a little bit confusing, so let me talk through it. So basically, they're doing their forecast for the capitals and the major regionals based on the revised figures. So the cash rate going up to by 4.35% by mid-2026 versus the last one they did in 2025. So if we look at the 2025 one, ignore the red numbers on the side because it's a bit deceptive. Pretty much that's the growth they were predicting. So they're saying, look, Perth still had 12 to 16%, Brisbane had 10 to 15%, Darwin 12 to 16% growth, Melbourne 4 to 7%. And we can argue about these. I actually disagree with some of the numbers. I think they're a bit inflated in some of the markets, and it's more to do with sentiment than it is supply and demand. Versus the column on the left, which is now what they're predicting. So you can see previously it was going from 12 to 16 in Perth. Now they're only predicting 10 to 13%. So it's a change of 2%, but it's still positive. The ones that probably worth noting are the ones where we can see minus growth. So where they were predicting, say, Melbourne and Sydney, 4 to 7%, 3 and 6% for Sydney. And now they're predicting -4 to -1% and -6 to -2%. So basically they're saying some markets are going to go backwards. The rest of the markets are pretty much going forwards. You can see even the regional towns, as long as they're basically underpinned by suitable economies, supply and demand, they're still positive as well. And getting 6, even 4 to 7% is still a good return. Like if I'm getting 5 to 6% on average growth for my property portfolio, happy days. That's what I want, and that's how I can keep accumulating. But the signs are still positive from SQM research. So they're still saying, good. If you live in Melbourne, Sydney, is there opportunities? And I'd probably argue yes. I'm personally looking in Melbourne. Palise Property, we're looking in Melbourne. Not where you think though. We're not buying the CBD. We're buying more the lifestyle surrounding areas where affordability is there and there's a lack of supply. So they've got good infrastructure. The people are going there, but they don't actually have their housing. And this is where the nuance comes. You can't just say Melbourne's a great performer. We're in Melbourne. The same thing for Sydney. I still think there's some bargains in Sydney, but you have to go further out west and further to the outskirts. But that's really interesting that even the big data sources are still predicting positive growth, even though everyone's saying the world's going to end, AI is going to change everything, all that jazz. Vickers has asked a good question about vacancy rates on commercial. I might leave that to the end as well because I'm going to talk a while for that. All right. So what this means for you? It depends where you're buying, but normally I've already said, like most of our people reaching out, our leads and clients are worried about the market. So there's less confidence there. So it's a harder job for me to convince people to buy because they're already a fear of is it the wrong time, what it is. However, counterintuitive to that means there's motivated sellers. So you can potentially pick up a bargain. But the core, which I just showed, the market fundamentals are still strong. And if you buy to supply and demand, you get the growth. But let's simplify it a little bit. What are your options? Like we can keep talking about the world blowing up and nuclear warheads and GFCs happening and all that type of stuff. But there's only three options you've actually got to do. First one is you buy now and the market's a little bit softer and you pick up a good buy. That's pretty much it. And we'll let growth do its thing. We'll see how the market goes from there. Second is we wait on our hands and we see what the market does. If it goes backwards, then you can come into the market and hopefully pick up a bargain. But let's just say it drops 10%. I just showed you that the markets were growing over 20 years, 167% anyway. So you're only really saving 10%. If you buy $1 million property for 900 grand and it's worth $2 million in 10 years time, cool, it's an extra $100,000, but it's not really changing the dial that much. But then the question becomes, how long do we wait out of the market? Like, is 10% drop when we're going to come back in? Is it 20%? Like what is your period? That for me is completely unknown. And if you follow all the buyers agents and things like I do, like if they had that glass ball that they could actually crystal ball that they'd look into, they don't. It doesn't exist. They'd be on their own private island with Richard Branson. They'd be a billionaire. If you could pick the market to 6 months. So like I mentioned at the start of the presentation, if you're holding this property for more than 5 years, who cares, like, if you're buying at 5% cheaper or 10% cheaper, or you're buying in a hot market, like, just buy to the fundamentals. And then the third one, don't buy property at all. You think it's going to be a bad asset class. Move your money into something else. Shares, gold, silver, Bitcoin, whatever it is. I'm not an expert in those ones, so make your own decision there. But all the graphs will show you that property is the most stable one long-term. And I'm a low-risk investor, and that's why I buy property. So they're the kind of ones we're looking at. But looking at the long view, will pass at some point. Things will stabilize, and Australian property is always in a short supply scenario with a high demand. So I'd say the art is choosing those areas with the high demand and low supply. Now for the fun part, let's do some Q&A. I skimmed over that fairly well because, like I mentioned, I'm not a politics guy. I don't even follow it. I just follow trends and data and make my decisions based on that, and I'm all about lifestyle. But let's go through some of the questions because there's some good ones here already. Let me just scroll to the top to make sure I didn't miss any. Rodney, I'm going to answer this one even though you're not probably going to like my answer. So Rodney has said, will today's webinar address the government's proposed tax policy changes? I appreciate the resilience of property during periods of geopolitical turmoil, but I'm curious about what happens when we superimpose policy changes like abolition of negative gearing reductions. It's one of the ones that always brings up, and people make decisions based on not buying based on tax. I don't even care about what the tax ramifications are because the government always want property to grow. Like there's an incentive for them property. They also want it to transact hands quite a lot because guess what? Stamp duty is really attractive to them. So they want it to be a stable market. I will never forecast something happening. The removal of negative gearing, I got into this, what year was it? 2014 or whatever it was. I starting like my property buyer's agent journey. And then they were talking about removal of negative gearing. And now we're 12 years later, my properties are worth triple. If I listen to that, I'm losing money. So I don't make it based on things that aren't going to happen. If it's dotted on the line, it's there, then I might change my decision. But I'm not going to follow what media is saying and what potentially think until it actually happens. Here's the next question from Win. Commercial interest rates are 7.4% and two more rate rises coming and yields are less than 6%. How can we still make positive cash flow rather than putting more deposit? Simple answer, you can't. That's commercial is not what it was 5 years ago. You can no longer buy something on a 80% loan at a 6% net if interest rates are 8%. It's not far off. It's only like $1 million property. It might be 5 or 10 grand off. That's just the market you're in. No offense, you've missed it. The golden years 10 years ago, the even more golden years were 20 years ago. But the same arguments for residential. I used to be able to buy, I had a $50,000 passive income from my residential portfolio, 7, 8 years ago from residential. Now you're lucky to buy a residential that's 20 grand a year negative. So my question to you is probably, would you rather go buy a residential property that's going to cost you 20 grand and hope that it grows more than 20 grand per year to break even, or buy a commercial that might cost you 5 grand and then because you've got a lease that says it's got rental increases at CPI or 3 or 5%, knowing that in 2 years' time it then breaks even, and then in 2 years' time after that becomes 15, 20 grand a year positive. And that's why it's still positive. Commercial will always be, because it's perceived risk, a better return. It will be 2 to 4 times the return for cash flow than residential. And I like it because I understand it, so I can get it right and buy it knowing it's going to perform really well. But yes, gone are the days where it's cash flow positive from day one. Unless your budget's really large, I wouldn't let it affect your decision. Like, say we go back 2 years ago where I could have bought you $1 million property that was 10 grand a year positive, and now we buy it and it's neutral. Yes, it's 10 grand, but I don't think you should be buying $1 million asset and worrying about 10 grand a year. If that 10 grand a year cash flow really changes your life and causes stresses, I'd probably say maybe then commercial's not right for you anyway. But then if you're going to go out and buy a residential that's 20, 30 grand a year negative, then that argument's frivolous anyway. I would much rather, especially if you're young and got the energy, go get another job and just survive that first 2 or 3 years to then get the positively geared asset. But yes, interest rates will change. However, you'll be too late. If interest rates come down, prices will grow and a commercial will become really attractive. If inflation keeps going up, you got to remember you're going to have 4, 5, 6, 7% rental increases every year because it's got to match inflation as well. So it's just getting that balance right. But I always tell people, buy when you're ready, buy when you're educated, buy when your finances allow. Like it's not a thing of timing the interest rates, the market. The market's going to do its thing. If I'd bought anything 5 years ago, I'm laughing now. So I think I'm going to be saying the same thing in 5 years' time. Vickers has asked a good question. Where can I check vacancy rates on commercial? You can't. You can check the big data. So if you want to write this down, write down Savills, Knight Frank, CBRE. So they're the big dogs that own big portfolios. And type in on Google like CBRE office report, and then type in like 2025 H2 or Q3 or Q4. They do PDFs generally every quarter to every half year, and they'll give you the vacancies, not for retail per se, but for industrial and office space. But be aware, it's normally the ones that are bigger than 5,000 square meters. So 90% of the people watching this, there's a couple hundred people watching, aren't buying Westfields or a major warehouse. They're buying the smaller ones. But it'll give you a good clue. So it'll actually show you like a Sydney map, and it'll show you the different areas of Sydney, what the vacancy rates are. Some of the areas in Sydney, like North Sydney, are still 0% vacancy rate for big industrial. I live in Northern Beaches, Brookvale, for instance, 0% on the big ones. I talk to real estate agents there almost every day. They've got a list waiting for big blue chip tenants that want to space there. There's no physical space to build it. So that's where you get the big data. So for office, you can probably trust it a bit more because an office is a box that people work out of at a desk. Industrial, take with a little grain of salt, but if you're buying in a 0% vacancy rate region or very low and you're getting a smaller warehouse that's probably going to support those big businesses, it's probably going to be okay. So use the big data as a guide. Then once you actually find the property, the real grunt work actually begins. So the two ways we do it, you go on CoreLogic first and foremost. If you don't have a membership to CoreLogic, you'll have to pay like the one-off, I think it's $500 or whatever it is to get access. Then you have to do some grunt work. You have to click every comparable property that you can find, look at the previous leasing campaign, see how long it was leased for, and then that again, that's still a gauge, assuming they've put the right information in, and get a bit of a feel there. The second one is actually call multiple property managers. So we normally call 2 or 3 property managers. Not so much anymore because we've got our own database. So if we buy in a suburb, we've already collated all this data, so we can kind of look it up and we just add to it. Funny enough, Albert, who did the PhD, that's one of his job, is collecting the data as well, because it's obviously really important to our investing decisions. And then talk to multiple property managers and say, hey, what do you have on the books? What went vacant? How long it was vacant for? And it's old school. It's empirical. You have to write it out. Commercial, there's no recorded data like residential because it's Wild West. Like, I've given my tenants incentives that effectively aren't on the books because you're saying, oh yeah, like COVID happened. Don't worry about paying rent this month. Like, there's no record of that unless you actually go through my bank statements. So there's all that type of stuff, but just do the grunt work. This is what puts most people off commercial because it's okay for me. I got a team of 24 people now that just do most of the grunt work for me. But if you're an investor and you find an area, you got to do 5 to 10 hours of work just to kind of get that vacancy rate. Then if the next property finds in a different suburb, and you got to do it again. And most residential investors just want to sit on realestate.com and look at some pretty photos. Commercial, boring grunt work, but the rewards are there if you get it right. So I hope that answered your question. Anonymous attendee. Can you run through the broad cap rates you're seeing in the market right around by sector, around the early 1 million price point? If what sector is presenting the best value, relative value? Okay, good question. I'll answer this holistically and then I'll probably go in a little bit deeper. Generally, if for industrial, you're not getting a 6% in front of the number in a capital city, especially in that $1 million price point. You're just not. Gone are the days of 6%. Some regional areas like Rockhampton, Mount Isa, things like that, you can get it, but the vacancy rates are high. So it's like you're going to take it on there. We're generally buying between 5 and 5.5% for really good quality industrial stock. Areas we're mainly buying for that sub 1 mil price point, you're going to be looking at Perth, Brisbane, Canberra, and surprisingly Sydney. We're getting quite a lot of like small warehouses, like 80 to 150 square meter warehouses in Sydney at that price point. But again, it's at 5 and 5.5%. To answer for retail, generally slap on about 0.5%. We have got some where we get up at 6.5%, but on the whole, we're buying around that 6%. You're getting an extra 0.5% because there's more risk. So the risk with retail is if it goes vacant, typically in a good area, it's still 6 to 12 months vacancy. But the period of tenure is generally much longer, like it's 7 to 12 years for a thing, because like if a hairdresser is doing really well, they don't leave to go to a bigger hairdresser. They open another salon. The opposite happens for industrial, especially in the $1 million price point. This is where it gets more volatile, and that's why some buyers agents say don't buy there. The smaller ones, you'll have probably on average only 3 to 7 years for a $1 million warehouse tenant because their business is going to go one or two ways. They're going to grow and outgrow the space and move on. So funnily enough, the better the tenant, the quicker they're going to leave, or they're going to close up shop because they're not making money. So they're going to leave, but because it's just a concrete box with a roller door, a new tenant comes. Typically, some of the areas we buy, it's less than a month, but on average, proper answer is 1 to 3 months, probably on the whole there. So there's nothing wrong with the sub-mill. You just got to be aware that there your risks are more turnover of tenant. Whereas as you move up in price point, the 2, 3, 4 mil, you start going to more blue chip tenants. You start going to, I don't know, longer leases. You start going to freestanding. You start going to multi-tenancy. You start seeing more value add opportunities. We've bought like a Red Rooster and a Pet Barn and a Subway, super cheap auto, and you start moving to those when you get into kind of the 3, 4 mil price points as well. So I'm not saying they're better deals. There's more variety. My brother, who works in the due diligence team, loves buying the little cheap ones. He'd rather have 10, $500,000 warehouses than have one $5 million one. I'm the exact opposite. I can't think of anything worse than managing that many properties. That's why I sold my residential ones, because it was just doing my head in. I'd rather just have a few blue chip assets that I don't have to worry about, easy to manage, just watch the money roll in every day. So there's no right answer. One of the educators in the space actually said, don't buy sub 2 million because there's actually too many investors in the space and there's too much interest, which I find weird because don't you want to buy properties? We talk about supply and demand. They're not building any more demand. Like you buy in a well-encapsulated industrial estate, physically can't make any more demand. Sorry, supply, but you've got a huge demand. Like, isn't that a recipe for growth? So if you want my 2 cents, I actually think we're going to get the most growth out of the sub-$1 million asset classes because there's the biggest pool of people. But then I think it'll tail off. So it's getting that balance right. Still good assets, still focused there. But yeah, it is getting tougher. Hi, Kirsty. Where can you find sold prices on commercial? It's not as well copied in, but again, CoreLogic is generally the go-to. There's some other websites you can kind of use as well, but CoreLogic's one most people use. Again, it's not always there. It's not always right. Cross-check. Become friends with sales agents. They know off the top of their head. Like some areas, like you buying, there's only 5 or 6 commercial sales agents for a certain asset class, like industrial. They've got all the data. One of the benefits of using a buyer's agent like us is we've already got all the data because we're literally Albert, who did the PhD. We've collated it in that suburb. Here's the last 2 years of sales. Here's the last 2 years of rentals. Here's what went vacant, how long they were vacant for. So we kind of know the areas we need to look. We don't have to do the grunt work every single time anymore. Oh, I like this one. Anonymous attendee. Are funds listed or otherwise a good entry point to commercial? I assume you're talking about syndicates. So there's two, don't get confused. There's joint ventures and then there's syndicates. Joint ventures is just when people come together and they have shared ownership and it's small. To do a joint venture, you basically need less than 2 mil capital raised or less than 20 investors. So that's like people just going together. Because you've said funds, I imagine you're talking about syndicates. Let's go positives. Positives of syndicates is basically you get to buy a really cool blue chip asset with lots of tenants, and it's low risk if you buy the right one. If you buy the right one, I see heaps of these commercial syndicates that go out and they're just buying petrol stations, and that's how they get the return. They get like the 7%, 8% return because they're buying these high risk assets. They go buy like 5 petrol stations as part of the syndicate. If 1 or 2 of them close down, your return's gone. If there's one land contamination issue, you're gone. So yes, you can get the return, but if you're getting a good quality blue chip location and a decent return, yes, they're a good investment, but you're missing one of the biggest pieces of the puzzle for the commercial. So you got the question of buying one by yourself or buying a syndicate. Syndicate, you don't have any control. You also don't leverage your money as far. So you're just getting a return. So you still get a little piece of dividends of the capital growth, still get the net returns. Be aware a lot of those is actually gobbled up. So the people presenting them are taking their 1.2%, the AFSL's taking their clip, there's a management fee. So they're taking a big piece of the pie as well. But at a later stage of your investing career, I would say they're a pretty good one. If you're not leveraged up past 50% anyway, and you're only putting in and you just want a good solid return, yep, buying the right syndicate is a good one. We're looking to it at the moment. That's how I know so much about the back costs of setting them up and things like that. They make sense for that. But if you're starting out, leverage is your friend. I would much rather, if I've got, let's say, I'll just use round numbers, million dollars cash or $1 million equity in a property, I would rather leverage that into like a $3.5 million asset that I own because his money's gone 3 times as far. Well, it's going 3 times versus 50%. If I get capital growth, I get way more return. If the rent increases, I get way more return. And I've also got control. I get horror stories. I would say every 2 weeks, someone calls me up about these syndicates and life circumstances change, which they're always going to do. You're always going to have deaths in the family, broken marriages, I don't know, family breakdowns. I've had all these personally as well. So like, and you're going to need to get out. You can't get out. You're locked in for periods of 5 years. Even at the end of the 5 years, sometimes they don't let you out because they basically vote to stay on and you're locked in. So make sure you get your own lawyer, look at those regulations and the things that you sign. The personal one, you can flog it within a couple months, sell it and move on. So there's a pro and a con to each. I'm a bit more of a control freak. I like to have the control and the leverage. But yes, there are positives to negatives to each one. Oh, I like this one. Jay, why do you not sell off the plan commercial properties in good hotspots identified by you? It depends what you're asking. Do we buy off the plan or do I sell? We've looked into doing developments where we build a commercial warehouse complex and we'll sell them off. That's different game though. That I wouldn't sell that to my clients. That would be to third party investors to buy there, or I'd keep some because basically, if I know it's a good area, I'm going to get a good return. You can do it there. We occasionally buy off the plan, i.e., new ones, but only ones that are basically complete. I wouldn't touch one where it's just they haven't even turned soil yet. Like those can last 3-4 years and they've got like sunset clauses where they get closed down and nothing happens anyway. So you've just parked your money in something that you're not getting a return. But the ones that we know are in really good hotspot with tight vacancy and just being completed, we've got some good relationships with developers and builders. The negative with those is to get finance, you generally need a lease back or they need to be pre-tenanted. So the ones that basically there's already a tenant who signed a lease for it, happy days, happy to buy those. The ones that are a lease back, i.e. the developer's giving you one, we still buy them occasionally for the right investor if they're looking for high depreciation, but you got to be very careful legally that they're going to pay out. As we all know, developers, they claim that they're the nicest people in the world, but in reality, they're looking for a return. There's sneaky things they can do to get out of basically those lease backs. So we make sure that generally we try to get the lease paid up front into a trust account, into the property manager's account. So the funds are there. So if that company dissolves or goes phoenixing, we've already got the money and it gets paid out slowly. But getting finance for an off the plan is the hardest one. Not against it, just adds another layer of complexity and risk. Bill, you have asked a very similar question, so I think I've just answered that for you, mate, and looking forward to talking to you. I think it's next week or this week? Well, next week. Oh, I like this one. This is a nice big juicy one. Hi, Steve. Resi versus commercial with 350K deposit. Already have 3 resi, 2.3 mil value with a 43. Oh, that's good portfolio. And wondering what about purchasing 2 resis for the next 5 years, then selling down select assets for a larger commercial purchase using deposit for commercial now. Have good equity in current portfolio you can extract. Okay, there's going to be probably 2 ways I break this down. The first one is you've got an LVR lower than the highest LVR that you can get in commercial. So normally the main negative of commercial is you need a 30% deposit. On paper, I just showed you in this presentation, same capital growth, 3 times the cash flow. So the only advantage resi's got over commercial is you can get 80, 90% loans. So if you were coming to me with no properties, I would say residential because I'd rather you go buy 3 residential properties on 90% loans, pay lenders mortgage insurance, and have 3 times the portfolio. Because if I get the same growth, then therefore I'm making 3 times as much to then transfer it into commercial. But you've got a really strong LVR, it's 43%. So leverage is off the table. So the question I'd probably be asking yourself is, why are you going residential? Is it fear of that commercial's too risky? Is it just a known class that you like? Like, why are we buying residential? The 3 questions I rabbit on all the time on these podcasts and webinars is, what are you actually trying to achieve? What time frame? And then what do finances allow? And you kind of match that up. So someone like me, the banks were willing to lend me 12.5 mil for residential. And I was kind of like, I don't want to leverage up to the eyeballs because then Palise property still needs to go really well. If there's an interest rate rise, I'm stuffed. If there's an economic downturn, I'm stuffed. So I didn't borrow anywhere near that because my goal is no longer portfolio size. I don't care about that. And I know it's a very privileged, arrogant position to be in. I care about cash flow, increasing cash flow from 250 to 400 to 500. Like, that makes me feel wealthy because I can do what I want. I can fly business class with my family. I can travel. Like, I can do all that type of stuff. But for you, you're in a good position. You've got a lot of equity. So I'd probably sit down and actually have a proper think about what is actually wealth to you. Is it time? Is it like passing on to your kids? Is it just getting to a number? And that's fine as well. I've got a lot of friends who are ego investors that want just certain net wealth and that makes them happy. So just be honest with yourself and work out, what are you actually trying to achieve and what's the purpose of this? Because it is just paper money when it comes down to it. So you got to at some point transform that into something usable, whether that be experiences, time, gift to family, gift to friends, whatever it may, gift to charity, and then go from there. But I'd definitely be looking at commercial unless you're using leverage, because what's the benefit? You've got a good amount of equity as well, so you can move into that kind of higher price point where you get some really good quality assets as well. Is there a replay of this webinar? Yes, we're because you're registered, we'll send it to you. And it looks like we're also going to send our PhD employees thesis to you on this with all the data as well. We might even give you some other cool stuff as well. So keep an eye out. We might even send like our hotspots for commercial and residential for over the next 6 months and stuff like that. All right, Kirsty, can you talk through the challenge when a small business goes bust and your property is left vacant? So tenants are always going to leave, whether it's actually the same outcome, whether they go bust or whether they just move on happy as Larry. The main difference in opinion is going to be if they are going bust, my advice is get onto it early. This is going to seem really cruel, but generally don't give charity to your tenants unless there's actually a clear light at the end of the tunnel. If you're in a non-seasonal business, let's say you got a retail and it's in an area where it's non-seasonal and they're struggling with rent, they start dropping 1 week, 2 weeks, 4 weeks, 6 weeks behind. I can tell you now, 99% of businesses don't come back. So being ruthless while you're under the lease terms to then start advertising and minimize that vacancy period is really important. If they just leave, you basically just got to advertise. But again, make sure you've got a good property manager because you should know that 6 months prior to them leaving, which should give you a good lead time. Most of the stuff we buy, industrial, we get filled within 1-2 months. Retail, some areas, I got one yesterday, a client messaged me saying, oh, we filled it within a month. In reality, I had one that went vacant in 3 months. I've got another one that's a freestanding retail that's been vacant now for 6 months. General period is 6 to 12 months. The keys are get a good property manager and do a good marketing campaign. You'll find most of the best quality ones, tenants that you'll get come in the first 3 months. So pay the premium advertising on Real Commercial and all those websites, and don't squabble and try to get something at the start. Like if they come in and they're saying, oh, we want to pay 10% lower than what it's advertised, give it to them if they're a good, solid business. Because I can tell you from my experience in the last 5 years of owning commercial, if you don't, then second, third, fourth, fifth month, they see that it's been there vacant for a long period and they've got more negotiating power anyway. So don't be cheap. Don't try to save 10 grand here and there. Don't go hardball all the time. Just get a good quality tenant in, but it's the negative of commercial. You got to plan for it, but you also should have your buffers for this as well. So as I keep mentioning, you get 3 times the rent. So if I've got a retail shop giving me 6.5% return, and I get a tenant for 3 years, theoretically, I'm getting 3 times rent. I've got another 6 years of it being vacant before I'm in a worse cash flow position than buying a residential. And the reason that kind of startles people is people are very good at budgeting week to week and they can handle, oh, my property cost me $50 a week. They're not good at budgeting 3 years down the track and making sure they've got a buffer. People live like week to week, year to year. So this is the difference with commercial. Have your buffers, and your buffer changes based on your portfolio, how many commercials you have, because if you've got 5 and they're all got leases ending in different times in the different markets, you probably can actually, surprisingly, have a less of a buffer than just having the one, because if the one goes vacant, you don't have the other positive cash flow ones handle it. But yeah, it's always a scary situation. Just be aware, this is why I don't chase yield. Other buyers, agents, other investors go, oh, I'm going to get you a 6.5%, 7%. But that's not free. That's because they're vacant and they'll have long periods of vacancy. I will buy the 5.5% sleep a night one in a bulletproof location with lots of foot traffic for retail or a really tightly held industrial complex every day of the week, just because I don't have to stress about these situations. All right, let's go to Aiden. These are good questions, by the way. Hi, Steve. I have 4 resi and I'm close to stepping into my first commercial. Am I better leveraging off the resi and borrowing more money to obtain a lower value commercial to start, or am I better selling resi and stepping into high value commercial, better cash flow? I do understand the personal circumstances, but generally love to understand your thoughts. I hate to say, Aiden, we know each other. Like, it is personal. It's a personal decision about what you're actually trying to achieve. The negative with it going into a lower LVR commercial portfolio is you'll be less wealthy in the longer period. So like I could leverage up to the eyeballs and get up to 70, 80% and have a much bigger portfolio. And if the portfolio doubles in 10 years time, I am laughing because I've got a much bigger portfolio that's worth double. I will make more, and that'll give me way more options to do the sell down, buy more commercial assets or whatever it may be. but I'm more susceptible to risk now. And I'm also more susceptible to the business keeping earning income. It's going to be negatively geared. Interest rates change. World wars happen. The whole point of this webinar, I don't want to take on that risk. 25-year-old arrogant Steve, 100%. I was leveraged to the eyeballs. I was borrowing money, 5 grand off my dad when the hot water system blew up, moving back in home to increase my borrowing capacity. I was doing all that jazz because there was no real downfall for me at that point in time. If it all went completely tits up, I would have moved back in with dad. He would have fed me. I would have had a roof over my heads. I would have regrouped. Now, 2 kids, partner, mortgage, all that type of stuff, different stresses, business employees I got to look after. There's different stresses. So I'm not really answering your question. Just come back to what do you actually want from property? Like I can tell you now, getting to 10 properties was the most miserable point in my life. Went through a divorce, had to give my dog away. My mum passed away from Parkinson's. So like it's not going to make you happy. Work out what part of property makes you happy. For me, it's passive income. For you, it might be building a nest egg for your kids. So just be true to yourself. Thank you, Jeff. Great webinar, Steve. Let's go to Dean. Self-managed super fund question. I have around 650K in my self-managed super fund. I'm still relatively young and focused more on capital growth than yield. Would it be better to buy one commercial property and split the investment across 2 residential properties? It depends what the goal. Self-managed super funds are very funny one because I kind of treat it like a different person to you, especially when you're younger, because it's like this make-believe thing that you're not really touching till you're 65. So it's like, what are we doing with it? I would talk to a mortgage broker first and foremost and see if there's any difference in borrowing capacity. If your residential capacity, because you're young, you got time on your side, your residential capacity comes at let's say 3 mil. Your commercial capacity comes at 1.8 mil with that 650. I'd probably say the residential, and again, personal circumstances. If you've got a good, stable job, can keep paying your super, you're not going to go travel for 5 years and not earn income, and you can support that, I'd probably say residential. Leverage is your friend. I don't care about property in itself. Like it's just bricks and mortar to me. It's just a playing with numbers. So I'd probably say for you residentials, a safer option because you don't have to worry about the vacancy where you have to handle the mortgage. You get it split it, hopefully get a bigger loan, a bigger asset pool as well, and then go for there. But again, if you want to go have a gap year for 3 years and travel overseas and you need something that's looking after itself a bit more, then commercial makes more sense. But leverage is your friend, so I'd probably go residential. Not financial advice, everyone. There's another self-managed super fund. Let's go that one. I've just set up a self-managed super fund. Our combined balance is around 700K. Personally, we have one PPR with a valuation of 2.4 mil with a loan 650K. Very, very well done. That's getting paid off very quickly. Would it be better buy one commercial or a few resi via self-managed super fund personal? Age 47. Okay, still fairly young, but starting to get to the pointy end where you want to probably start retiring 60, 65. You've kind of asked 2 questions in one. You've kind of asked whether you buy personal and self-managed super funds. So I think the last time I answered about the self-managed super fund, it's kind of like another vehicle, and there's different ways you can attack that. So that's more of a what does retirement look like for you? This is where you got to talk to a mortgage broker and accountant because I normally say never make tax decisions for your property investing. But this is one where the main benefit of self-managed super fund is tax savings. Like you can have a 200K passive income tax-free at the end of it. There's also negatives of residential where because land tax issues and things like that, just paying for it can be really difficult. So I can't really answer that one, I think, for your self-managed super fund. Outside of that, similar to before, what are we trying to achieve? And I know I keep harping on about this, what is success? What does wealth look like for you? For me, you're at the age where it's a harder one. If it's a younger, 25-year-old, 30-year-old client, leverage is your friend. You're probably a bit more established in your life, and because you got the PPR, you've minimized most of the risk because you've actually got quite a lot of the equity in that property. But I'd probably go commercial. If your short-term goal is getting some passive income and building from there, have a caveat to that. You might absolutely love your job, low risk job, earning lots and lots of money. Don't want the risk of commercial. Go buy residential and then move into commercial down the track. But again, your LVR is really low, so you're losing the advantage of residential anyway. Okay. Oh, I get to do a self plug for this one. All right. Nickel has said, I've always been investing in residential market. Is it still worth start looking at commercial market? And for investing, as you mentioned, they're not positively geared anymore. If yes, where is a good place to start? Looking into commercial is always a good idea. Same as looking into developing, looking into residential. By understanding all three of them, you means you can make an informed decision. This is where I get a self plug. I'm not sure if you can see. I may have a commercial book. So get my commercial book first and foremost. It's free on the website. So just go to paliseproperty.com and it's you just got to pay for postage. Send that to you. I've also got a free commercial course as well. So on the website, on Palise Property, you can go to my thing. It's 10 hours of me rabbiting on like this about all things commercial. Do it. You got nothing to lose. Doesn't cost you anything. Worst case is you know more so where in your portfolio you're going to slip commercial into. But I wouldn't use the positively geared part of commercial to make your decision because residential is not positively geared anymore. So like saying, oh, I don't want to buy commercial, it's not positively geared. I'm going to go buy this really negatively geared residential. Like that's counterintuitive. So make it based on borrowing versus what you're trying to achieve. These are some good strategy questions. All right, let's go to another anonymous attendee. 48 years old, 3 investment resis, 2.2 mil loan. Cost to hold all 3 is 15K per annum. Just solid position if you can afford that. If I sold all 3 today, I would end up with 400K cash. Should I invest in commercial or hold resi and wait a few years to go commercial? It depends on what your LVR is. I may use that to make a decision. If you're 2.2 mil loan and you've got a 2.6 mil portfolio, for instance, I'd probably say not selling that is probably not a great option. Unless you're going to buy the exact same value. So that's why the LVR comes in, because if you're like 80% leveraged, you're going to buy smaller commercial. Let's say your portfolio is 2.6. Then because we need a 30% deposit, you're going to buy a 2 mil portfolio, and buying a 2 mil commercial, it's not going to retire you now because like I said, on all the other questions, it's going to be pretty close to neutrally geared. So you're kind of just doing it for the sake of saving 15 grand a year. If that 15 grand is killing you though, financially, then it's probably worth discussion. But I'd probably be inclined to hold. Selling property is an absolute bitch. Like you're going to pay a pesky agent 2.2% to go open a door on Saturdays in a good market and claim he's 40 grand to that. You've already paid stamp duty on those properties as well. So there's another 3.5%. Then the property you replace it with, you've got another stamp duty of 3.4%. So with all the costs of legal, solicitors on the last one and the next one, we're getting close to literally 9-10% to transfer that property. So just be aware of that. When you do something like I did and sell my residential portfolio, it's a 10% loss to transfer that into something else. That's got to be taken into account as well in the short term. I'd be inclined to leave your portfolio. But again, maybe shoot me a message to Steve at Palise Property and let's go through maybe step by step of what LVR you have and what borrowing capacity would change if we sold 1, 2, or 3 of them. Maybe a 2-pronged approach is probably better. Maybe sell 1, try to get into a smaller asset commercial, and then move from there. But again, it's going to come down to what you're trying to achieve. Aiden said, thanks, and looking forward to starting the journey with you and the team. Me too, mate. Thank you so much for jumping on. Anonymous attendee, have a bit of a basic question. I've bought 4 residential properties before and always received keys at settlement. I've purchased my first strata titled retail commercial property and didn't get any keys. The seller mentioned the keys are currently with the tenant and even the manager didn't seem to have a set. Is that normal? I would expect in the shopping centre mall set up, but wasn't sure the same applies to strata title properties. Yes and no. So we always try to get a full handover and you should have a separate set of keys. However, it's generally not that because it's their premises. It's not like residential where you have a keys to do inspections and that. If they want to put a big lock on the door, they effectively can. For an industrial, that is. So you don't always get it, but part of a good property management conveyance is you should always have like a set of keys, the access codes, all the information there. This is normally what gets lost at handover and where poor property managers and poor conveyancers and solicitors fall over. Part of Palise Property, we actually do like, basically we follow up every client 1 month after settlement and then every 6 months after that. The 1 month after settlement that's because that's where most of the issues actually happen. Like transfer of bonds gets lost. We'll make sure that happens prior to settlement. The keys get lost. The tenants claim things that weren't part of due diligence. So, oh no, the previous owner said I didn't have to pay in December, and there's always issues. So that's the tricky part of commercial. It's also the benefit. You get to reap the benefits of that kind of Wild West, but it's also a big trouble. But you can't do anything now. The tenant, as long as they're paying rent, in reality, if they start missing rent, you can actually go in and lock the premises with your locks and things like that. But again, seek legal advice for that. But that sometimes does happen. That's not uncommon. Alana said, thank you for this informative webinar. You have an awesome team. I've onboarded and can't wait to acquire my first commercial. Oh, thank you, Alana. Looking forward to working with you. Ben said, can you talk a bit about offices, Steve? I assume he means office space, not police officers, even though I used to be called police. Still, the policies are here. Offices. I really like them, and we still buy suburban offices. So what I mean by that is the small scale 1-2 story office spaces. But I normally try to get them where they have a dual use. So one of the ones we bought on the Northern Beaches was a 2-story office building. The top floor was a ballet studio. So it's still retailish, and that could be like a Pilates. It could be a gym. It had the zoning for it, and downstairs was a law firm. I really like those because, funnily enough, vacancy rates in suburban areas are tighter than the CBD. I've been getting asked whether to buy CBD retail. I can get you a 7% net return if I buy you an office space in a CBD. However, vacancy rates are still like 15 to 17% in most of the capitals. So all the questions that we're talking about, risk with retail and industrial with vacancy, you're getting a better return, but you're coming on there. If I'm going to take on that risk, I want to have either something freestanding or something that's versatile. I'm not going to buy the 17th floor of an office suite unless it's for my business and I'm going that way in the self-managed super funds. But again, I still recommend against that because you're putting all your eggs in one basket. But if you can get something smaller, even something that, like I said, freestanding, that you can actually rejuvenate, renovate, change the tenancies, like turn into medical, like gives you some opportunity. If there's a value add, I'm open to it. I would not be touching it unless I can get an extra 1 to 1.5% over industrial. Otherwise, what's the point? Why are you taking on the risk? Do I think it's probably the bottom of the market? Yeah, because they're not building anymore. There's not huge amounts of stock coming on. Will the bottom? It's not a bouncy ball, guys. Market doesn't drop and then comes back straight away. The flat period could be 5, 10, 15 years. Things could change. So not against them, but take it with a grain of salt and be a bit weary. Nicole has asked a question. What is your take on flipping old residential properties for profit? I'm assuming you're talking about buying a new residential and then flipping it. If it's in your portfolio, of course, do a renovation. Basically, the general rule of thumb is whatever dollar you spend, you want to get $2 back from minimum. So if doing a 50K reno gives you an extra 100 grand sales price, it's worth doing. If you think it's only going to give you 75 grand worth of extra sales price, don't bother with all the taxes and agent and capital gains and all that type of stuff. It's probably not worth the exercise. New ones, I'm yet to meet anyone who's doing it successfully now that's not buying regional. There's too much. This is going to be the negative of too much education out there. People are too switched on now with property. Like commercial, when I first, for instance, wrote my book, no one was looking at commercials. Maybe like a pool of 5,000 people that knew it. Now, like I've given away 50,000 books. So like there's just a bigger pool of people now that know property, know renovations. They're doing that. The margins are much slimmer. As I mentioned with other questions, selling costs are huge. You're paying stamp duty, selling agent costs, stamp duty on the next property. You need to make more than 10% there to make it worthwhile. So I'd probably say you need like a 20% uplift, and that's still only a 10% margin. After capital gains tax, that's whittled down as well. So it's not quite there. I'd say you'd have to go regional and creative type properties where you're changing like the purpose of the use. But again, that's time, that's expertise. You're going to be traveling really far. You're going to be looking every night. Nothing's free. So I'm kind of, I think, gone are the days of getting the bargains where you renovate it. At All Investors, I don't know anyone who's still doing it successfully that's not doing something creative, like i.e. adding an extra room, turning the lounge room into a second bedroom because it's really large, turn it into a tiny home, turn it into a boarding house. Like you normally have to do something creative. But again, that comes with risk because it's going to be new to you. You're not going to be educated on it. And most people learn through a tribulation of fire. So if you've got any areas you're thinking, let me know. I'm really happy to chat about it. With buying property in self-managed super fund, what are your thoughts if we have sufficient funds? Should we buy with no debt versus borrowing with self-managed super fund? Really good question because you're in a privileged position, well done, where you can buy cash, which most people can't. So they don't even have this discussion. I would say it comes down to a couple things. What your age is, so how close is actual retirement, because the lenders are going to be looking at that anyway of how quickly you pay it off. And then how much you actually have there, i.e. like, are we talking 500K versus, so if there's 500K, I'll probably say leveraging at 50% and getting $1 million asset. There's more options for you that are lower risk where you can get a 5-year lease. So at the end of the 5 years, you've whittled down most of that debt anyway. If we're talking $1 million, then you start moving into bigger asset classes where longer leases as well. But again, so matching up your age versus what the average, I would say for someone like you, it wouldn't be a question of leveraging up to the eyeballs of 70%. It's what LVR based on your age can we get where if the tenant did leave at the end of the tenancy, is the majority of the debt paid off? But then also aligning that to your goals. Like if your retirement has a certain figure that you need so you can travel the world in business class or do whatever you need to do, then we need to work backwards from that. And then we extend the time frame based on the risk profile there. I haven't really answered your question, but I've tried to just give you the general discussion on the information I got. This is an interesting question. I used to get asked this like 5-6 years ago all the time. It's one of the exit strategies I have in both my books, my residential commercial book about living off capital. So without leveraging benefit, if I only want to live on income from the capital from cashing out, will ETF investing is more passive and less fees and cost of buying. Might also be income that, okay, I'm going to get lost here. Might also be high income than commercial, which can be negative cash flow. I thought you were going to ask, should I just leverage the capital for retiring? So some people do that. So say you've got a $1 million asset that's paid off. Some people, as opposed to selling and transferring that into, say, a commercial property to the passive income, they'll actually leverage the asset out. So they'll say pull 20% out of the property, live off that 200K for 3, 4, 5 years. And then what happens is because the rent is still strong enough to pay a 20% mortgage, pays it back down to the level. So some people actually live off the capital on their property, not the cash flow. So you can actually leverage a property. This was really popular in the 80s and 90s, and people would use equity for their lifestyle. So they pull out equity and buy boats and holidays and all that type of stuff. And it still works really well but most people don't have the capital because unless you're a business owner or you've been in the market for a long time and you've got really, really low LVR, you can't do it. But then also counterintuitively, I could get it so you don't have to refinance, move it into a high asset base, get the cash flow from that. I'm not an ETF guy, so I'm not going to answer that. I'm the property guy and I'm going to stay in my lane for that. But I think that's kind of what you're getting towards. Ooh, this really, really good question. Is there a risk where commercial is being artificially inflated by investors? I love this question. I'm going to answer with residential first. Residential, 100% yes, there are markets that are artificially inflated by investors. So as you all know, there's hundreds and hundreds of resi buyers agents. Most of them don't even have a portfolio themselves and they're just fulfilling their portfolio based on obviously their buyer's agent fees, getting that. And they just all flood into a market. Like one of their buyer's agents has 250 deals a month. And then they're going to pump into Darwin. Of course, prices are going to grow. If they're buying at 300 and then 3 months later, the next client's buying it at 320, and then a few months later, the next one's buying at 350, the next one's buying at 300. That is a false floor economy. It doesn't mean it's actually going to go down though. It could if it's overinflated, but as long as the rental statistics stay tight, so if vacancy rates still stay tight, that market will just probably stop and just flatline. So they're artificially creating their own effectively equity. So all their clients are like, oh, it's great. You don't want to be a client that's come on at the end though. You want to come into when they're buying in the first 6 months. If they say we've been buying here for 2 years, so this question to ask them, how long have you been buying here for? They go, oh, we're buying here for 2 years. And then they're also boasting they're a really big buyer's agent doing hundreds of deals a month. Do you really want to be on the tail end? So I'd probably might go into their earlier markets and get that inflation there. So That is definitely happening in the resi market. Commercial, a little bit different. Funnily enough, most of the areas I buy, you get a premium if you sell your property to an owner occupier, i.e., a vacant property. So vacant properties actually sell for a higher premium than tenanted ones. Again, I'm long term. I want to buy an investment that over 5, 10 years has such a demand it's going to grow. It can't really be inflated the same because owner occupiers still have a big portion of the market. And then the time that it is investors, uh, you're buying in a poor economy then if you're doing that anyway. Because if it's a whole market's investors, how stable are the businesses? Because most of the people watching this, they're not buying Westfield shopping centers and cinemas and big assets. They're buying small ones. Most small business and medium business want to own the space they live in as well. So if you are buying an area where it's just investor base, you're probably buying the equivalent of like a new estate for residential where they build all these new homes. They're on their fringes building all these new warehouses and selling to investors. However, check with town planners. This is where you talk to town planners. Most of the councils actually require a certain percentage to be to own occupiers versus investors. So there is more control on it. So when they're building infrastructure, um, it's hard to become inflated by investors. However, the cap rate compression in that market is actually a thing though as well. As I said before, like 10 years ago when there was 5,000 commercial investors, now there's probably like with me and Rethink and even like the investor kits and Jack Henderson and all these other buyers agents are trying to do commercial now. All of a sudden the pool of 5,000 has probably gone to 200,000, 300,000. So there are more investors, which will give you a small cap rate compression. But then what will happen is you won't be able to buy anyway because investors aren't going to sell with tenanted properties, so the sellers aren't going to sell to investors who need a tenanted property. They will wait for it to be vacant and then sell it to an owner occupier. So the fundamentals should still apply. But really, really good question. I haven't been asked that before. Do you work on any projects in Hobart? Does the large infrastructure project of a new stadium and sports team create consideration for emerging markets? Answer the first question, we do buy in Tasmania. Not so much in Hobart though. Surprisingly, yields are really poor. Like you're only getting like 4.5%, 5% in most of Hobart. And for me, I think there's better markets to buy in. We actually buy properties in the periphery cities of Tasmania, but it has to have an X factor. There's some cool infrastructure projects going on like Devonport and areas like that. But bang for buck wise, you can go buy in one of these other Launceston or Devonport markets and for $2 million get a huge freestanding building with multi-tenancies at a higher yield than say buying like a Brisbane or a Perth. But the vacancy periods are going to be longer. So you're balancing the X factor. So you might get multi-tenancy or freestanding or a medical tenant versus the vacancy period. So we still buy in Tasmania. You mentioned new stadiums. That for me doesn't actually change fundamentals for my commercial investing. Yes, you can probably get some cool retails. So we've bought retail centers that are right on the fringe of stadiums. Be aware I don't want to say seasonal. What's the word I'm looking for? They're obviously dependent based on when there's an event. So like they can sit there ghost town until Friday, Saturday night, or if there's a concert on Wednesday night. So they're kind of short influxes. The vacancy rates on those, if they are struggling, are going to be really, really high. But fundamentally, like that's entertainment. I'm not buying for entertainment. For my industrial is based on like production, services, car mechanics, wholesalers, fabricators, distribution, all that type of stuff. A stadium for me isn't going to change anything. Same as a university isn't. That's good for people. But again, it depends on what type of asset you're buying. But I wouldn't use this new stadium as the sole purpose unless there's some other major infrastructure going on around it. Trams, trains, buses, new roads, new buildings, new office towers, new industrial complexes. So there's probably more to it than that. Oh, I like this question. Abby has said, hey, Steve, any tips for what to look for in a good commercial property manager and what to ask them? The lease on my first commercial property is coming up in a year and I want to make sure I'm all over, needs to be done, and the tenant leaves. Early indicators that will be vacating. Commercial property managers are really hard to find out if they're a good one or a bad one because you don't know you've got a bad one until your tenant leaves and you don't have one. I would just ask them about history of similar properties that they had vacant and what they did differently. Get a copy of my commercial book, which is behind me on the website. I've actually got a list of about 20 questions to ask them. Some of it's about their systems and processes and things like that. But the key one is to ask them what they do differently to other property managers in the area to get something tenanted. Based on where you're buying and what you're buying is going to change that as well. Because if it's like retail, having someone localized central that has really good community relationships is probably more important. If it's industrial, that's completely different. That's system processes, how do they, the list of waiting tenants and things like that. So for me, it's always the local knowledge, their systems, their processes, and what they do, how heavy their marketing campaigns are, and how depth they are. Some areas, a smaller property manager is better, where you're dealing with the owner of the business directly, and they're going to give you the best service possible. Surprised me some other times in certain assets, going to one of the big ones that have a good list of people can be there. If you want, shoot me an email, steve@paliseproperty.com, with the location of your property. And because we've literally bought thousands plus properties, I'll tell you the good feedback and the bad feedback of certain agents. I can recommend 2 or 3 to you. Mama Bear, good name. Thanks. Your podcasts have been huge help in our acquisition journey. We're looking to acquire another commercial property soon without selling any of our current ones. Our portfolio is around 2.5 mil with loans 990K and 100K in offset, good amount of equity. Total rent is 174K, and all the properties are positively geared with rent currently going towards the loans. Do you think it's feasible to take on another commercial property cash flow purchase given cash flow and high deposit requirements? Short answer, yes. We don't buy just to this market now. Like, let's just go back the last 4 years. 4 years ago, they were saying market's too soft in commercial, don't buy. Then they were saying interest rates are going up, don't buy. And then the property prices kept going up as well. So it also doesn't matter, like, now what's happening, because in 6 months' time, interest rates could be down, inflation could be up, inflation could be down. So don't make it based on that. Make it based on your goals. You're in a very, very strong position already. So like, you've got a great amount of equity. If you let it keep paying off, are you happy with that outcome and that cash flow? If the answer is yes, why are you taking on more risk? Don't do it. Even though it might benefit me, I'm a buyer's agent and I can get you a really cool property. So if you're happy with that, I'd say you're in a really good position. But you've also got a low amount of debt. So you can probably take on a bit more and keep it low risk as well. But I've just been wound up by my team before we get kicked out of this thing, because it went on way longer than I thought we are going to go. Thank you so much. Guys, this has been amazing. Thank you so, so much. Let me stop sharing my screen. Really, we had close to 180 people most of the time watching this, which is amazing. Self-plug. If you want to speak to me, my team, or strategy, email us, go on the website. There's heaps of resources. We'll send you Albert's PhD if you contact us as well. If you want a free 15-minute strategy call as well, we can do a roadmap session after that. Reach out, steve@paliseproperty.com or paliseproperty.com. Awesome, guys. Thank you so much. Cheers.